Everybody, welcome to part 3 of this shortened video series, which we're going to be going through and covering units of production in terms of determining depreciation expense. I'm the accounting professor. I'm here on YouTube. My name is Bennett Tchaikovsky. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any redistribution is expressly prohibited without the prior written consent from yours truly. The opinions expressed herein are those of the author only and not the author's employers and or other affiliated organizations. Okay, so let's go through and take a look. So we're now doing units of production. Now, when we're dealing with units of production, we have the same rules. We can only record basically depreciation so that the net book value is equal to the salvage value, and we can never depreciate it so the net book value falls below the salvage value or what we expect to receive for the equipment. Now, when we're dealing with units of production, the thing I want you to understand is that this is not a function of time. So there's going to be no partial period depreciation expense, similar to like the straight line or double declining balance. With this one, it's purely going to be based on units produced. Right, so we've got acquisition cost, right? Acquisition cost, salvage value, and then we've got the estimated number of units to be produced. And again, estimated useful life is not considered here, right? What we're going through and doing is this is depreciation based on a function of units being produced. So the way we're going to do this is right over here. So when the actual formula for this is the top part of it looks like straight line, acquisition cost minus the salvage value. But instead of dividing it by the estimated useful life, we're now going to be dividing this by the estimated number of units to be produced. This is going to give us a depreciation rate per unit. When we take this depreciation rate per unit, multiply it by the units produced, this is going to give us the amount of depreciation expense. How do I record it? It's going to be the same way as we've always done. I'm debiting depreciation expense, crediting accumulated depreciation, and that's how we do it. So remember, accumulated depreciation is a contra asset account, not closed out to retain earnings. This is where we're going to be accumulating our depreciation. Now, here's our example. Okay, so on May 1st, 2029, LGA purchases equipment for $50,000. Installation expenses were 20, shipping were 10, salvage value of the equipment was 20, and the estimated useful life of the equipment is 4 years. The equipment is expected to produce 120,000 units over its lifetime. The units produced were as follows. So it gives us the number of units that are being produced, and we're pretty much asked to do the same things as we were doing for the previous example. And this would be, so to kind of correct myself on the fly here, that's what's always wonderful about going through and doing these. I believe we're now on example. No, this is example 4. So cool. Okay, so this is example 4. All right. So over here, example 4, let's go ahead and take a look. So let's first go through and figure out, we purchased equipment for 50, installation was 20, and shipping expenses were 10. So my acquisition cost is going to be 50,000 plus 20,000 plus 10,000. So right over here, this 50 is my purchase price. This is the install, and then this is shipping. So when I add up these three amounts, this gets me to $80,000. My salvage value is 20,000, right? So over here, I've got 80,000 minus 20,000 salvage value. But because this is units of production, what we're going to be going through and doing is we're going to be dividing this by my estimated number of units to be produced, right? Because remember, what is the formula? It's acquisition cost minus the salvage value divided by the estimated number of units to be produced. Okay. So I'm going to divide this over here by 120,000 units. So this is going to give me over here, this is going to be 60 divided by 120, and this is going to give me a rate of 50 cents per unit. Okay, so for every unit that I depreciate, I'm going to go ahead and take 50 cents worth of depreciation. Okay, so as we come over here, let's go through and we're going to kind of take the same, do the kind of the same formatting, right? So right over here, I have to go through, and when I bought the equipment, what did I do? Right, so when I bought this equipment, I went through and said, okay, equipment, 80,000, cash, 80,000. Right, so when I bought the equipment initially, right, on my balance sheet section, so LGA, balance sheet, as of, and then we're going to have over here assets, and we're with equipment, we're in a non-current assets, right? So we're going to have our equipment less the accumulated depreciation on the equipment is going to give us equipment net. Okay, so when I first bought this thing, and this was going to be on 5/1/29. Okay, so I went and bought this equipment on 5/1/29. Okay, so over here, I paid 80,000 bucks for the equipment. And as of this first date, I haven't depreciated the asset. So what it looks like on my books is it's coming over right over here at 80,000. So over here, I'm now going to do this on 12/31/29. I think we only have to do this out for a few years. Okay. So that's what it looks like when I originally went through and bought the equipment on 5/1/29. Okay. Now, when we get to the end of the year, right? So we get to year end, what do we need to kind of go through and do? Well, over here, every year we have to go through and say, all right, how long, doesn't actually with this one, it doesn't matter how long, it's how many units did I produce. So I'm going to record depreciation expense, and then I'm going to be crediting accumulated depreciation on equipment. So the one thing that usually gets students into trouble is that they'll see this 20,000 in the first year, and they'll say, oh, you bought it on May 1st, 2029. So I need to multiply this by May, June, July, August, September, October, November, December, right? But not here. This is purely based on use. So over here, I produced 20,000 units produced times 50 cents per unit is going to be 10,000 of depreciation expense for 2029, right? So this over here, it basically does not matter in terms of when we're looking at this. I don't have to multiply this by 8/12. So on 12/31/29, to go ahead and record 10,000. Credit accumulated depreciation on equipment on 12/31/29. Okay. So when it comes to these amounts over here, right, what is this going to go through and look like? Well, my accumulated depreciation balance obviously had a zero balance, but now this is going to basically show a credit balance over here. So my equipment net is going to be 70,000. Remember, we can never have this go below 20,000 bucks. What is $20,000? This is my salvage value. So we're okay to keep on going through and depreciating it. Okay, so this is basically over here. This is for the first year. Now we're going to go to year two. Okay, so over here, in terms of going over here to year two, on basically on my 1/1/30 balance, this is going to have a zero balance. However, my ending balance for why is this zero? This is going to be closed out to retained earnings. For accumulated depreciation, though, the balance carries forward. So over here, I'm going to have a balance of 10,000. So now the question becomes, well, how many units did I produce? And how much should I be going over and recording? So I've got 45,000 units produced. So 45,000 units produced at 50 cents per unit. It's going to give me 22,500 of depreciation expense for 2029. So over here on 12/31/30, and this is going to be 45,000 times 50 cents or 22,500. So this is 12/31/30. So my total balance in the accumulated depreciation on the equipment is my beginning balance from the prior period plus the depreciation that I had from the current year. So over here, my balance sheet looks like this right over here. Now, when it comes to recording, 32.5, not 22.5. Okay. right? So over here, this is going to be 12/31/30, the ending balance. This is what goes to my balance sheet. Now, when it comes to going through and recording this as a journal entry, it's really going to be the same thing that we were going through and doing before. So here I'm debiting depreciation expense. I'm crediting accumulated depreciation on the equipment. Over here, this is, we'll call this debit credit, and we'll do this as of 12/31/29. Okay, so when I'm going through and doing this, right? So my depreciation expense for the first year was 10 grand, crediting accumulated depreciation on the equipment for the second year, 22.5, crediting this over here at 22.5. So this is to record depreciation expense, right? The format of the journal entry does not change. It's always going to be the same. Okay. Now, when I get over here to 2030, so this is 2030. Now I'm going to come over here to 2031. Okay, so 1/1/31. This balance is going to be 0. We don't know what this balance is going to be yet, but my prior year balance on 1/1/31, this is going to carry over. So over here, let's go through and we'll figure this out. So how many units did I go through and produce in 2031? Well, I produced 50,000 units. Okay. Now, when I produce 50,000 units at 50 cents per unit, this is going to give me 25,000 of depreciation expense for 2031. Okay, and I just copied over. Oh, good job, Bennett. Copied on the wrong one, but that's why we use Excel for this kind of fun stuff. I don't really use Excel. I trod through it. Okay, so this is going to be 25,000, 25,000. So now my accumulated depreciation balance is 57,500. So equipment value is not going to be changing over here. My accumulated depreciation is now going to be 57,500. My equipment net is now 22.5. Now remember, I can only depreciate up to the salvage value. So what is exactly happening here? Well, I got this equipment and I kept on going through and producing, right? So in 2029, I produced 20,000 units, right? My cumulative units is going to be, at this point, is just going to be basically be 20,000 units. In 2030, I produced 45,000 units. So my cumulative units is going to be my cumulative from the prior period plus the 45. In 2031, I produced 50,000 units. And now my cumulative units produced is going to be 115, or the 20 plus the 40 plus the 50. Now I have a limitation here. I can only go up to 120,000. So let's see what would happen if I go through and do this over here. So let's copy this down. So over here, 1/1/32. So my prior balance comes over here and it's going to be going through and carrying over. When I get over here to 12/31/1/1/32, well, here I produced 28,000 units. Okay, so this is going to be 28,000 units produced at 58 cents, at 50 cents per unit, is going to be 14,000 tentatively of depreciation expense for 2032. Now, if I put in this 14,000, what happens is now my accumulated depreciation is going to go up to 71,500. So my net book value is at 8,500, and I can't do that. Why? I can never have this go beyond 20,000. So what do I need to do? Well, if I look over here in 2032, even though I've produced I've basically gone through and I've depreciated all these amounts over the years. So even though I went through and I produced a total of 28,000 units for this particular year, I can only depreciate 5,000 of them. And why? Because my cumulative units cannot go beyond 120,000, or I end up over depreciating the asset. So if I come down over here and I take a look at this, that's not going to work, right? That doesn't work for me. So what do I need to do? Well, if I come over here and say, well, instead of 28,000, we're going to do 5,000 units produced at 50 cents per unit is going to give me $2,500 of depreciation expense for 2032. This is what we call forcing or plugging in depreciation. When I go through and do this, I now have a balance here of 60,000. So if you're taking my test, this is what I'm going to try to get you to do, is I'm going to try to get you to over depreciate the asset. So you want to be really careful in this final year or as we get to the very end. Now, of course, over here, when I get to 2033, for 2033, we had 30,000 produced, which is great. But I'm not going to depreciate any of them because I've already reached my limit. I cannot go beyond salvage value. So for over here, what would the balance sheet look like? It's going to look exactly the same as the previous year because we can no longer continue to depreciate the asset. So when we're dealing with units of production, let's just kind of go over through this again. It's not a function of time, right? So when we're doing this, it's going to be a function of what we go through and produce. So the 4 years, it doesn't really matter. It could be 30 years, doesn't matter. What we're doing here is we're basing our depreciation based on how many units we're going through and producing. When we do the equation for this, it's going to look a lot like, the top looks a lot like what we did for straight line, but the bottom, the denominator, is going to show the estimated numbers of units produced. It's going to give us a rate per unit. We're then going to take that rate per unit and multiply it by the units being produced, and that's what's going to tell us our depreciation expense. However, we have to be very, very careful because if we exceed the cumulative amount over here, then I've got a problem. And I have to stop depreciating it once we get to that point in time. And you're going to find this as a very common theme when we're also going through and looking at double declining balance. So that is over here. This is the end of our units of production. Probably went a little bit longer than my shortened video series allowed me to do, but that's what always is fun about these. So thank you for being with me here today. Please leave any questions you might have below. Appreciate your liking and subscribing to the channel, and I will see you on the next video. Have a great day.